Well, as you saw, it was another triple-digit loss in the equity markets today in the wake of the Brexit shock. My next guest says this selling that we're seeing, overdone. For perspective, we're joined by Path Trading Partners, Bob Iaccino. Bob, so good to see you.
Good to see you, Greg. How are you?
Not too bad at all. Not great if you're long these markets, which, I've got some investments which are. The second day now, triple-digit losses. The hangover continues, but you say it's overdone.
Well, the depth of today surprises me. I'm not going to lie to you. I didn't expect it to be as bad as it was on Friday. We're about halfway to a formal correction again, which I don't know if you can call it a correction. When you look at the sideways movement of the S&P since late last year, it essentially looks more like a giant range than a bull market that needs a correction. However, speaking toward all that, when I look at the UK Brexit, what bothers me about this sell-off and what makes me believe that it's overdone is it's been really orderly. It doesn't feel like a panic. There's definitely been institutional selling. Friday was positions that were set up to benefit from a Bremain vote. Can we be done with all these terms? A Bremain vote. And those positions were exited on Friday. And now you see institutions kind of saying, well, the responsible thing is to be on the sideline and see how the negotiations begin, how they play out. But they're going to take a long time. I look at a country like Switzerland, which has sort of a side deal with the EU. They're not in the EU. Switzerland's doing great, second lowest unemployment, second largest per capita GDP, and they're a banking center without being part of the EU. I don't think the UK suffers unless we have some of this typical European hard feelings things that they tend to do, and some of the leaked documents have kind of pointed toward that a little bit.
So, Bob, when you see a sell-off of this magnitude, you feel that it's overdone. Good names get thrown out with the weak. Does this become an opportunity for people to move in, and perhaps will we see a rebound even as early as this week?
I think so. I think you'll see it this week. Couple of things. You mentioned the strength in the dollar, obviously pressuring all commodities except gold. I think crude oil is going to rebound. I think it's going to rebound in a big way. This is a dip I want to be long, especially in some of the oil names, and especially in some of the smaller ones where you can really benefit on a risk-reward basis. I want to stay away from financials. I don't know what the effect of this is going to be on financials. You had JP Morgan denying that they're getting out of the UK, but saying that they might need a European Union headquarters. That's more money spent, more hiring, and we obviously aren't going to see a steepening yield curve anytime soon. The Fed's on the sideline. They're out of it for now. We might have actually had the first one-and-done rate hike from the Federal Reserve that we've ever seen. The December last year's rate hike may be the only one that happens. So I think you kind of have to stay away from banking specifically. Some of the financials might benefit. CME Group, TD Ameritrade might benefit from increased volumes from this trading. So those might be some names to look at as they're falling, along with, again, some of the smaller energy names.
Now, once we move beyond the shock of the Brexit vote not going the way the markets had priced in, smooth sailing from there, nothing else to worry about in the world?
Well, we have this kind of weird U.S. election coming up. Before I came on, you mentioned us as south of the border. It's always strange for an American to hear us called south of the border. And, what does it cost the American economy if Canada builds a wall if Donald Trump's elected? I mean, that might be something that pops up. It's just a very weird election. I don't think either candidate is really good for the market in the short term. I think Hillary Clinton provides a longer-term sell-off. Donald Trump provides an immediate sell-off. So there's a lot of risk to the market depending on what happens there when you combine it with some of the congressional re-election or lack of re-election that we're going to see. So I think the U.S. election is the next risk point. It's certainly not the Fed, and the Brexit situation is going to take a long time to play out. So definitely the U.S. election is something to keep your eye on.
I understand. Earlier we were talking about some of the sectors you like. I understand in terms of names, you like Devon Energy. What is it about this company?
Well, I do. They survived $26 a barrel in February pretty well. We saw about 77 U.S. bankruptcies, according to the Wall Street Journal, over the course of the sell-off from 2014. Devon was not one of them. They remain with a pretty strong cash position, and they've benefited almost dollar for dollar on this up move in oil that we've seen from 26. They've gone from the low 20s into the high 30s. They're around $31 to $33 right now. Anything above $30, I like that. And again, I'm playing the recovery of oil. I think you go to those smaller names because names like Exxon and Valero really aren't participating as much as you would think they would. The smaller names is where you get bang for your buck. And I think Devon Energy is one of the safer ones.
Selling a lot of assets, though. I noticed 1.3 billion of gas-focused upstream, plans to sell billions more. How much can you cut here just right down to the bone?
Well, I think that's one of the things they've been good at. Again, as you see the stock price as they're selling assets, the stock price has held in and even rallied. They're raising cash. Are they raising cash for future CapEx? If we get some of the stable prices around $55 in oil that I think we'll get through the remainder of 2016, $55 is not a price where you see a tremendous amount of North American drilling start again. And CapEx has been cut quite a bit. But I see them as raising cash for the next stable price move. You know, fracking technology is going to get better. It improved by 30% last year. That's going to continue. It's sort of a bright light in the fossil fuels arena. I think they're going to be ones that's set up to benefit for that.
All right, Bob, always a pleasure speaking with you.
Thanks, Greg. Good talking to you.
That was Bob Iaccino, co-founder and chief market strategist at Path Trading Partners.